Good evening. Welcome to TopGunStockTrading.com. This video is for the week ending February 16th, 2014. All right, folks, let's get into the action. This is basically a weekly review of what happened last week, what we expect to happen the next week, and the following weeks to months. Hey, listen up. We expected a pullback last week on Wednesday, Thursday time frame. We got a minor pullback on Wednesday. On Thursday, the markets gap lower, and then off to the races they went, rocketing higher Thursday, and then on Friday as well. So on light volume, so you know that this rally, if you want to call it that, has less conviction than if it would if it had a higher volume. You can say decreasing volume. The line I've drawn in there, I have drawn in there for last week to illustrate the declining volume, but this rally has taken off. Why do I think the cycle failed? I think the light volume, the snowstorm on the East Coast may have decreased the amount of traders or institutional traders that actually made it to their desk to actually trade the market. That's my thesis. I think that's why it failed. But don't get me wrong, the tape is a tape and it never lies. So the fact of the matter is it went up and a couple points, as a matter of fact, up to 184.02, and we can't discount the fact that it's up this high. It's going to go up and kiss double top at least before it heads back down. I still expect the weakness to come in this week. This 4-day shortened week, Tuesday, Wednesday, Thursday. Expect weakness to come in to this market. And I'll talk about a couple trades that I got off near the Thursday and Friday of last week. Because of what I anticipate in this market coming up. So that's why I think it's still went up on light volume. Make no beans about it. Hey, this is up on thin air again. Light volume, less conviction. This market is on borrowed time, in my opinion, and it will be heading down. For that matter, I did get in the SDS last week, a half a position, and I'm looking to get in the other half of my position on Tuesday morning, Tuesday afternoon. If this market gaps higher into double top here, or about the 185 level is where I'm looking at to get in some SDS. But what's going on here is they're getting the little investor into this market. So I say, hey, the institutions aren't participating. Who's participating? It's the little guy. It's the average investor who has been afraid to get in this market. Up until this point, they see this dip and they think this is the last dip before the great big stampede to new highs and rocketing higher. So I better get in. It's either now or never, and they're coaxing the last investors, little guy, average investors into this market before they drop it. Like I said before, I mentioned before, margin is at all-time highs. What's margin? It's the borrowing of money to buy stocks. It's at all-time highs. The last time it was the last all-time high, if you will, was in 2007. And the one before that was in 2000. Well, what happened during those 2 years? 2000 was a dot-com bust, and then 2007 the stock market obviously took a downturn in the Great Recession, as they call it. So, and we're up there again. We're above those levels that we were in 2007. So the little guy is leveraged to the hilt, and it's going to hurt again when they go down. Let's take a look back over the, if you're a buy and hold kind of guy, let's take a look at what kind of return you would have accomplished had you been in the market. Let's say, we'll put it on a monthly scale, the last 20 years. So if you're a buy and hold person and you bought in back here, I don't know, take your pick, 2000, you're buying in, well, I'll even give you the benefit of the doubt, anywhere between we'll say this last pivot here in 98 all the way up until 2000, somewhere in here you're probably averaged in, because nobody buys their whole position all at once, at least you shouldn't. So the retail advisors or financial advisors, if that's what they call themselves, they advise to buy in average dollar cost average into the market. So you're probably somewhere between an average between the the low here and the high here, which is, I don't know, 150. We'll call it 150 for ease, and we'll call it $100 here. So you're averaging at 125 here. Is your average dollar cost average. Market goes up, you're in the money, you're happy, and then you see your total balance whittle away, whittle away, whittle away. Finally, here towards the end, you're like, holy smokes! The average investor goes out. I'm like, I'm getting out. I'm getting out of this market before it goes down even lower. They sell at the lows. The market goes back up, back up, back up. Over the next 3 or 4 years, the little guy goes, oh shoot, it's time to get back in this market. I'll dollar cost average back in. So let's say you sold, you dollar cost averaged out, and you dollar cost average back in. You're probably right back in around, I'll give you the benefit of the doubt, $125 again. And then you see the big sell-off, and I don't think anybody had a chance to dollar cost average out of the market during that big sell-off, or at least the retail investor. You either got out right away early, or you let it ride to the bottom, and then probably most people got out at the bottom. January, February 2009, only see this thing rip higher, and now are getting back into the market right now. So let's just say you dollar cost averaged. Let's say the best case scenario is you dollar cost average back here at 125, and you have nerves of steel through two crashes. Back in the year 2000 and 2007 and 8, you've nerves of steel. You stayed in the market the whole time, and now you're at $184, and you dollar cost average in at 125. Okay, fair enough. That's a fair assessment. So you're up 60 bucks at most. So that's about 50% return, and over 14 years. Well, I said you got in at 98 here, so 98 to 2014. That's 16 years. You're 50%. That's about 3% a year. So that's not cutting it. You can almost get a CD nowadays. I guess they're still at 1%, but you certainly could have bought. There were CDs for more than that over the years, for more than 3%. So you're not doing so hot over the last 16 years. You're getting 3% a year. That's potatoes. So I think that's. That the buy and hold strategy is dead, and the market is one big game, and what the institutions do is they try to stoke fear and panic at the bottom, so you sell, and they tell you all is good, nothing can go wrong at the tops, and then they rip this market lower. So they coax the little guy to sell at the bottoms and buy at the tops, and that's how this game is played. The institutions reap all the profits, and the little guy has the worst timing ever. And again, that's to mitigate the worst timing, to mitigate these emotions. These financial planners will tell you to buy and hold. That way, there's no thinking involved. You dollar cost average up, you dollar cost average down. You're always dollar cost averaging, and you can see over the last 16 years, you would have made 3% on your money. So, not good return at all. Just to illustrate the game of it all, these institutions, let's see, there's many examples of how the institutions will upgrade stocks. Analysts will upgrade stocks when the stock's at the highs, or downgrade stocks when the stock's at the lows. Probably the most recent example is probably the one I can think of easily recently is Apple. When Apple is at $700, you get analysts coming out upgrading price targets to $1,200. Google right now is at its all-time highs, and I fully expect in the near future analysts to come out and upgrade Google if it hasn't already happened. Typically, when analysts or institutions come out and upgrade stocks or equities or commodities at all-time highs or lows, it means that the top or bottom is near. So I got oil up here. Oil as an example. Back in 2008, oil traded at a high of $147.27. I have a weekly or a monthly chart up here. So this is in the month of July of 2008. Flipping over to this chart here, or article, at the height of oil, May 2008, it reached a high of 135. Now, I don't know exactly what day this article came out and exactly what day oil was at $135, but it's fair to say that it was between 115 and 135 according to this chart. And it was near its top, I think we can say within 2 months of its top by the time this article came out. And as you can see, Oracle predicts $200 a barrel of crude. This published on May 21st, 2008. I could go into a daily chart of oil if I wanted to find out what the price of oil was on May 21st, but suffice it to say, it closed May 31st at $127 a barrel, $20 lower than its all-time high in July of 2008 of 147. So you can see this analyst, this expert, an oracle of oil, he works for Goldman Sachs, Mr. Murty. You can see an analyst at Goldman Sachs. Mr. Murty has become the talk of the oil market. He's predicting $200 a barrel oil for crude oil, almost to the month of the high. So you can see it's a sham. It's a game. These institutions, they want to get the little guy in to buy oil so they can sell into him. I guarantee you, Goldman Sachs has got oil futures contracts over leveraged, not over leveraged, but they have. They're looking to decrease their position in oil, so they have this analyst come out and predict $200 a barrel oil, gets the little guy into oil, buying oil so they can sell right into them. No more than 2 months later, oil reaches a peak of 147, and you can see by the beginning of the following year, January 1st, 2009, or the month of January, it closed at $41. So basically, you would have lost 70% of your money had you listened to that analyst upgrade of oil. This happens all the time. It happened with the housing market. Remember back in 2005, they're talking about making the housing ETF, so to speak, making houses such trade like on the commodities or the futures market, have housing contracts. And you can tell in the time cover back in 2005 as housing as your piggy bank. So you could tell that housing was at the peak in 2005. I just recently wrote an article about gold in January, last month in January, saying that the gold is going to have one of its best years lately. It's a bullish year. I didn't say one of the best years. I don't know what the best year of gold was. But it will be a bullish year for gold. And one of the reasons was Goldman Sachs and these other institutions are coming out saying, hey, gold just is going to have one of its worst years ever. In other words, meaning that in order to get into a position of gold, Goldman Sachs is going to need people to sell their gold to think gold's going down in order they can buy it at a lower price. And as you can see, the month of just in the month of January here, this is a monthly chart. Gold is up significantly, 3.5%. Just in the month of February, since January, I see it opened January 118. It closed on Friday at 127. So whatever 9 over that is probably about 8% higher, almost 8%, just in 2 months or a month and a half. So I wrote an article on this about gold and how gold was going to be higher this year. A good year for the commodity of gold there. So you can't believe the analysts, and almost a complete contrarian when it comes to the news. And that's one of the reasons why the only reason I watch the news is not to get my next trade, is to get not to follow those knuckleheads on TV, is to get the contrarian viewpoint. So whatever they're saying on TV, I'm going the opposite. And that's all they want you to do. They want to get a little guy investor in on one side of the trade, so they can either buy or sell right into the little guy. So that's the game. Don't be a victim of the game. You have to learn the charts, learn what the charts are telling you, and be able to think for yourself. Have a methodology, learn a methodology, be disciplined, and to take out the emotions out of trading. And that, frankly, that's what I'm here to do, is to teach you the methodology and to teach you the technical analysis that I use to trade. On to USO. Back to the analysis. I'll back up real quick to the spiders. Like I said, we're expecting some weakness to come in the market this week. There's a full moon on Friday, and typically the moon cycle portends pivots in the market, especially a full moon. It was on Friday evening, so obviously there's no trading day. Trading on Saturday. This is a 3-day weekend in the U.S. So Tuesday will be the first trading day, and we'll see how that full moon affects the market. What am I expecting on Tuesday? I'm expecting a gap up to a reversal. So looking to test these highs, a 184.89. 184.94, that was on the 15th of January. Probably gap up into that and maybe a reversal through next week. So that's what I'm looking for, weakness into next week for the spiders. Another leading indicator is if you notice that the spiders are almost at their highs here, the Qs or the NASDAQ have exceeded their highs, so they're off and running, whereas the IWM or the Russell 2000, this is the ETF for the Russell 2000, not even close to its high. So the Russell is lagging, and that's telling me that this market is due for a downturn. But when the Russell lags, the small business in America, when small business in America is not doing well, when it's lagging, that means this market's going downtown, Charlie Brown. So I'm expecting a pullback in the spiders in the near term. I don't know what the depth of the pullback will be. Like we talked about last week, I don't know if it's going to be a mild, kind of a bullish pattern type of thing for a new high, or it's going to be a steeper pullback. But all we can do is read the charts. I am expecting a pullback, and in fact, I did get into the VXX, which is a measure of the volatility on Friday afternoon. I got in at 41.65 right here. Almost nailed the lows. 41.59 was the lows. Again, this is a measure of volatility, and this ETF is very volatile. So if you're going to get into this, I would even do a quarter position size, not even a half. I would do a quarter position size, exactly what I did, just to kind of get in on get some exposure on the volatility that I expect that will be coming in the market next week. Next week's also options expiration week as well. So another game that the institutions play. I went over this one time before. You'll notice that the big stocks, the Apples, the Googles, the Amazons, the Green Mountain Coffee Roasters is another classic one, Netflix, all those big ones. Baidu is another one. You'll notice you heard it here first, you'll notice on Friday that some of these stocks will close on the even number because these institutions know where the closing price will give them to maximize their profit. And you'll see that happen on Friday, that they'll close right on the nose of an even number, of a big number, like Apple may close. It's been pretty strong here lately, so it may close probably 525-ish. Let's say, for example, right on the nose, and that's a pretty big number. Within a couple pennies, but they play that game. They know where their money is. They know where they can maximize their profits, and they move these stocks or these equities in order to maximize their profits and take money from the little guy. So I'm in the VXX. I expect lots of volatility. I told you about the SDS I got into. I'll probably be looking to get into my second half of the SDS on Tuesday when that market goes up and touches double top, or maybe trades a little bit through double top. But after that, I think it's downtown. I'm looking at the IWM to get in a short. I'm looking at this price right here. This red bar high, 115.74. I'm looking for a pierce of that 115.74, and I'll play the IWM short via the TZA. The TZA. It's a 3 times bear. Again, it's pretty volatile. It's got a lot of decay with it, so this is not a buy and hold type of ETF. You're going to lose money if you buy this thing and hold it for more than a couple weeks. So this is just a week trade for me, a week-long trade. It may very well be a weak as a not strong trade as well, but I was talking about the time length. I can get the IWM to pierce 115.74. Do the calculations yourself to find out what the TZA is going to be. It's a 3 times ETF. I imagine it's probably going to be a pierce of $16, somewhere around there. I haven't done the math yet, so over to you. I did get in the gold short on Friday as well. It did gap above that 200 there, so that kind of surprised me. I'll be monitoring this very closely if this confirms above the 200, I'll just step aside for a small loss and let it do its thing. But if it I'm not going to stop out unless it does confirm above the 200. So I'm looking for this thing to pull back some, probably maybe even below the 200 sometime next week, and I'll look to take profits. I'm in the short gold via the GLL trade, and I got in that 85, 50 and change, 55, something like that. So I'm out of money, 15 cents, no big deal. But like I said, if the GLD confirms above the 200, if you don't know what confirmation is, you have to come over to topgunstocktrading.com, and that's something I teach in my methodology, three-dimensional methodology webinar. Confirmation prevents you getting whipped out of trades before you should be. But it gapped above that, which is a river theory, which is another strong signal that it could be going higher. Again, I'll use confirmation to determine whether my next move I'm going to stop out of that trade or not. All right, folks, enough. I've said enough already. 21 minutes into this video. Just want to do a quick recap. Maybe some fatherhood there, if you will, in the game that's being played in Wall Street, and for you not to buy into it. So if you're buying at these highs, I think you're going to be in the hurt locker. The best case is for all your TSP, especially military TSP or government. I'm in the G fund, or the garage fund, if you will. Not making me much money, but I guarantee you it's not going to lose me as much as the C fund will lose over the next year. So that's where I'm at. Otherwise, you should be in cash, in my opinion. All right, folks. I'll see you on the charts next week. Have a good weekend.